I want to talk to you about 5 psychological traps that destroy traders. Not beginners only, experienced traders, professional traders, traders who know the rules but cannot follow them. These traps are invisible. They feel rational in the moment. They feel like good decisions, but they are the reason most traders never reach their potential. Let us begin. Trap 1. The illusion of control. Let me ask you something. Why do you draw those lines on your chart? Why do you mark those support zones, those resistance levels, those Fibonacci retracements? There's nothing wrong with any of those tools. I use them too, but I want you to be honest with yourself about why you use them. For most traders, it is not really about analysis. It is about comfort. It is about the feeling that you know what is going to happen next. Because that feeling, the feeling of knowing, it is deeply satisfying. We are human beings. We are wired to seek certainty. Our brains are prediction machines. We have survived as a species because we could predict where the predator would come from, when the season would change, what another person might do. But the market is not a predator. The market is not a season. The market is not a person. The market is the combined result of millions of decisions made by millions of people around the world every single second. People with different information, different emotions, different agendas, different time horizons. You cannot predict that. Nobody can. And yet traders spend their entire careers trying to predict it. And when the prediction fails, which it will regularly, they do not question the belief that prediction is possible. They question the tool. They switch indicators. They find a new strategy. They buy a new course. And then the new strategy fails too, because the problem was never the strategy. The problem is that you are trying to control something that cannot be controlled. I spent a long time in my career believing that if I just found the right system, I would always know what the market was going to do. I was meticulous. I was organized. I had rules written down in notebooks. I had back-tested data. I had everything. And still I lost because I had confused preparation with certainty. And those are two entirely different things. Preparation means I have done the work. I understand the context. I have identified the conditions that give my trade a reasonable probability of success. I am ready to act. Certainty means I know this is going to work. And the moment you believe you know, the moment you move from probability to certainty, you stop managing the trade properly. You do not put in the stop loss because you're certain it will not be needed. You add to a losing position because you're certain the market is wrong and will eventually come back. That thinking will end your trading career. The traders who survive, the ones who actually make money over years and decades, they have made peace with uncertainty. They don't need to know what will happen. They only need to respond well to what does happen. There's a massive difference. Stop trying to be right. Start trying to respond well. The market will surprise you. Every single week, something will happen that you did not expect. Your job is not to prevent surprises. Your job is to handle them without destroying your account and without losing your composure. Uncertainty is not your enemy. It is the environment you work in. And the sooner you stop fighting it, the sooner you become a real trader. Trap 2. Fear versus greed. I want you to think back to a trade you closed too early. You had a profit. The position was working, but something inside you got uncomfortable. The profit looked good on the screen. You thought, what if it reverses? What if I give all of this back? And so you closed it. And then maybe immediately, maybe over the next hour, the market continued exactly where you thought it would go. Your original analysis was right, but you did not stay in the trade long enough to get the full reward. Now think of a losing trade you held too long. The trade was going against you. It was clear. The signals were there. But you told yourself, it will come back. I just need to wait. Maybe you even added to the position, made it bigger, because if it comes back, you would recover faster. And it did not come back. These two experiences, closing winners too early and holding losers too long, are the two most common reasons traders fail to make money even when their analysis is correct. And they are both rooted in the same thing, emotional discomfort. When you have a winning trade, the profit on the screen creates anxiety. You feel it. The fear of losing what you have already made becomes stronger than the desire to make more, and so you close early to eliminate the discomfort. When you have a losing trade, the loss on the screen creates pain, real psychological pain, and your brain, desperate to avoid that pain, creates stories. It finds reasons why the trade will recover. It magnifies the evidence that supports staying in and ignores the evidence that says get out. This is not weakness. This is not stupidity. This is human biology. But in trading, if you respond to your biology without awareness, you will lose money consistently. I wrote about this in Best Losser Wins, and the title of that book is not accidental. The best loser wins. Read that again. It does not say the best analyst wins. It does not say the most intelligent person wins. It says the best loser wins. The trader who can take a loss cleanly without drama, without revenge, without an emotional response. That trader has a massive edge because most traders cannot do it. Most traders fight their losses. Most traders take their winners off the table before they mature. What I had to train myself to do, and it took years, was to become comfortable with discomfort. When I have a winning trade and it starts to pull back slightly, the discomfort is enormous. Every cell in my body says, close it, protect the profit. I have to sit in that discomfort. I have to breathe through it. I have to trust the process over the feeling. When I have a losing trade, the temptation to hope is powerful. The brain manufactures reasons to stay in. I have to override that with rules, hard rules, preset stops that I do not move, because I know that if I move the stop, I'm letting my emotional brain run the trade. And the emotional brain is not a good trader. Let your winners run. Cut your losers short. Everyone has heard this. Almost nobody does it consistently, because doing it consistently requires you to tolerate discomfort on both sides. You have to sit in the anxiety of holding a winning trade and watch the open profit fluctuate. You have to accept the small, sharp pain of closing a losing trade quickly before it becomes a large, devastating loss. Both of those feel unnatural. Both of those go against what your brain wants to do. But that is exactly why most traders fail, and exactly why the traders who master this make money. Trap 3, revenge trading. This one is personal for me. I know exactly what revenge trading feels like from the inside, and it does not feel like anger when you are doing it. That is what makes it so dangerous. It feels like opportunity. You have just had a bad loss. Maybe it was a trade that stopped you out for a significant amount. Maybe it was a series of small losses in a row, and something shifts inside you. Your chest feels tight. Your thinking gets faster. You start scanning the charts, looking for something, anything, to get back what you just lost. And you find it. Of course, you find it because you are not looking for a good trade. You are looking for relief. And when you are looking for relief, your brain finds patterns everywhere. It makes connections that are not real. It sees setups that are not there, and you enter the trade, and sometimes it works, which is the worst thing that can happen because now your brain has learned that revenge trading produces results. It has been rewarded for emotional trading, and it will do it again. But most of the time it does not work. Most of the time you exit that trade at a loss too. Now you have 2 losses, and the emotional pressure is even greater. What do? You look for another trade. This is how traders blow accounts. Not in one catastrophic trade, in a sequence of emotional trades where each loss feeds the urgency to recover the one before it. I have done this. I'm not going to sit here and tell you I always had perfect discipline. There were days early in my career where I sat in front of the screen until 8 or 9 o'clock at night, going through market after market trying to claw back a bad morning. I never clawed it back. I made it worse almost every time. Here's what I eventually understood. The loss is already gone. That money is no longer yours. The market has it, and the market does not owe it back to you. It does not care about your feelings. It does not care about your ego. It does not care that you need to feel better. When you revenge trade, you are not having a conversation with the market. You are having a conversation with yourself. You are trying to prove something. You are trying to restore your sense of control, your sense of competence, your sense of identity as a trader. And those are terrible reasons to enter a trade. A trade should only be entered when there is a clear objective reason based on your method, not because you feel bad, not because you need to recover, not because your ego is bruised. The best thing I ever taught myself to do after a loss was to stop, close the screens, get show less 1035 up, walk away, give yourself time, 30 minutes, an hour, whatever you need to let the emotional response dissolve. Because when you are in that emotional state, you are not capable of making good decisions. The part of your brain that makes good trading decisions, the part that is calm, rational, process-driven, that part is not in charge when you are in emotional pain. You have to wait until you are back in your rational mind before you put any more money at risk. The market will still be there. There will be more opportunities tomorrow and next week and next month, but only if you protect your capital today. Trap 4, confirmation bias. Let me describe something that probably sounds familiar. You have a trade idea long on a particular market. You have done your analysis. You like the setup. And then you start preparing your case. You look at the daily chart. You see a pattern that supports the trade. Good. You look at the economic news. You find a headline that confirms your view. Good. You read a market commentary online. The analyst agrees with your direction. Even better, you feel confident. You enter the trade, and 3 hours later, the market has moved sharply against you. Here's the question I want you to ask yourself honestly. Before you entered that trade, did you actively look for reasons not to take it? Did you look at the chart and ask, where is the evidence that this trade is wrong? Did you read any commentary that disagreed with your view? Did you genuinely consider the possibility that your analysis was mistaken? Most traders do not do this, and the reason is confirmation bias. Confirmation bias is the tendency to seek out, notice, and remember information that confirms what you already believe while unconsciously filtering out information that challenges it. This is one of the oldest documented cognitive biases in psychology. It exists in politics, in relationships, in every area of human decision-making. But in trading, it is particularly dangerous because the cost of being wrong is immediate and financial. I have watched traders hold on to losing positions for days, sometimes weeks, telling themselves a story. They would find news that supported their view. They would point to a long-term chart that justified the trade. Every piece of evidence that disagreed with them was dismissed. That is just noise, short-term volatility. The big picture is still intact. Meanwhile, the position was bleeding. The truth is that when you have an open position, you are no longer objective. You cannot be. Your financial interest is now attached to a particular outcome, and your brain, which wants to protect your ego as much as it wants to protect your money, will work very hard to keep you believing you are right. This is why trading rules matter so much. Not because rules make trading mechanical and soulless, but because rules create a structure that operates outside of your bias. A preset stop-loss does not care about your story. It does not read the news. It does not consider your rationale. It just executes when the market reaches a certain price. And that execution, however uncomfortable, forces you out of a trade that has clearly gone wrong, regardless of what your biased mind is telling you. I developed a practice over the years of deliberately searching for the counterargument before I entered a trade. If I was going long, I would ask, what would have to be true for this trade to fail? What would the chart look like if I was wrong? What is the strongest argument for the short side? If I could not answer those questions, if I could not clearly articulate the case against my trade, I did not enter it. Because if you cannot describe how you might be wrong, you are not analyzing the market. You are rationalizing a decision you have already made. Real analysis requires intellectual honesty. It requires you to look at the evidence that makes you uncomfortable, not to talk yourself out of every trade, but to make sure you are entering with open eyes, not just with hope. Trap 5, overconfidence. Every trader has experienced this. You go on a winning streak, 3 wins, 4 wins, 5 wins in a row. The account is growing. The process feels effortless. You start to feel like you have figured it out, like you have cracked the code. And then, almost without realizing it, you start to drift. The position sizes get a little bigger because why not? Things are going well. You start taking trades that are slightly outside your usual criteria because you trust yourself now. Your instincts feel sharper. Your judgment feels clearer. And then the losing trade comes. And because you were overconfident, the size is bigger than it should have been. And the loss hurts more than it should have. And now you are in emotional territory. Overconfidence is probably the most misunderstood of all the psychological traps because it does not feel dangerous. It feels like earned confidence. It feels like the natural result of success. And that is exactly why it is so destructive. There is a difference, a critical difference between confidence and overconfidence. Confidence is the belief that your process is sound, that you have prepared well, that you can handle whatever the market presents. Confidence is grounded in the work you have done. Overconfidence is the belief that you specifically are currently operating at a higher level than normal, that your recent results reflect a new elevated version of you rather than a normal statistical run of good outcomes. Markets are probabilistic. If your system has a 60% win rate, you will sometimes have runs of 8 or 10 winners in a row purely by probability. That does not mean you have leveled up. It means probability is behaving like probability. The danger is in attributing the streak to your own superiority, rather than to the natural randomness of outcomes. I've met traders, brilliant traders, who were destroyed by overconfidence after a great period of results. They increased their risk. They traded markets outside their expertise. They felt untouchable, and then one trade taken at a size that was never appropriate, wiped out months of accumulated gains. What I learned to do was to hold myself to exactly the same standards during winning periods as during losing periods. Same position size, same criteria for entry, same rules for exits. Not because I did not feel confident, but because I understood that the market does not care about my emotional state. The market does not reward you for being on a streak. It does not give you a soft landing because you have been performing well. Every trade is its own moment, independent of what came before. If anything, I became more cautious after extended winning periods, not less, because I knew from experience that overconfidence was waiting just around the corner, and I had trained myself to recognize the feeling of invincibility as a warning sign, not as a green light. When you feel like you cannot lose, that is exactly when you need to slow down. Okay, let me be honest with you about something. The 5 traps I have described, the illusion of control, fear and greed, revenge trading, confirmation bias, overconfidence, they do not go away. I still feel all of them after 20 years. The fear of missing a move, the discomfort of holding a winning trade, the pull of the revenge trade after a bad loss, the seductive comfort of confirming evidence, the feeling of invincibility after a great week. I still feel every one of those things. The only difference is that I no longer act on them automatically. That gap between the feeling and the action, that is where trading mastery lives. And that gap does not open by itself. You have to build it deliberately. You have to train it the same way a professional athlete trains their body. Not once, not for a few weeks, every single day. Here is what worked for me, journaling every single trade, not just the number, the emotion. Before I entered, what was I feeling? During the trade, what was my internal state? After the trade, win or loss, what happened in my mind? Over time, patterns emerge. You start to see when your psychology is taking over from your show less 1945 process, and you cannot fix what you cannot see. Predefined rules, not guidelines, rules, hard rules, entry criteria, position sizing, stop placement. All of it decided before the trading session begins when your mind is clear and unpressured. The rules are not there to restrict you. They're there to protect you from yourself in moments when your judgment is compromised. The pause. Before every trade, I take a moment. I ask myself one question. Am I entering this trade for a good reason, or am I entering it for an emotional reason? That single pause has saved me from more bad trades than any technical analysis tool I have ever used. Acceptance of loss. This is the deepest work, and it's uncomfortable. You have to genuinely accept, not as a slogan but in your body, that losing is part of trading, not a failure of trading. Part of trading. The best traders in the world lose on 30, 40, sometimes 50% of their trades. They still make money because they manage their losses and maximize their winners. Loss is not the enemy. Emotional loss, the kind that destabilizes your mind and sends you chasing, that is the enemy. If you can lose cleanly, if you can take a stop loss without a story, without anger, without needing to get it back immediately, you are already better than most traders in the world. I want to leave you with this. Every trader I have ever met started this journey thinking the main challenge was the market. They thought, if I can just understand the market well enough, the patterns, the data, the news flow, the technicals, I will make money. And then they learned the market, and they still did not make money because they had not yet learned themselves. The market is just a mirror. It reflects your psychology back to you in the form of your results. Your account balance is not just a financial number. It is a record of every emotional decision you made, every trade you closed too early, every loss you held too long, every revenge trade, every overconfident bet. It is all there in the numbers. The real work of trading, the work that most traders never do because it is harder and less exciting than studying charts, is the work of understanding your own psychology, identifying your patterns, watching your responses, building the discipline to act from your rational mind, even when your emotional mind is screaming. This work is never finished. There is no point at which you graduate. There is no certificate that says you have conquered your psychology. You work on it every day, every session, every trade. And slowly, slowly, the gap between what you know and what you do begins to close. That is the journey, not the perfect strategy, not the ideal indicator, not the right market. The journey is inward. I titled my book Best Loser Wins because I wanted traders to understand something that sounds paradoxical. The path to making money in the markets runs directly through your ability to lose well, not to avoid losing, not to win more, but to lose well, to take a loss without it destroying your composure, to move to the next trade with a clean mind, to never let a single bad result define your session, your week, your self-worth. That is the trader I had to become. It did not happen overnight. It was uncomfortable. It required me to look at parts of myself that I did not enjoy seeing, but it is the most important work I have ever done. And if you are serious about trading, not just for the money, but for what it can teach you about yourself, then I encourage you to start that work, not tomorrow, today. Look back at your last 10 trades, not just the entries and exits. Look at the emotional story behind each one. Ask yourself honestly, where did psychology drive the car instead of your process? You will find the patterns, and once you find them, you can start to change them. The market will still be here. It will be here tomorrow. It will be here next year. There will always be more trades, but every day you trade without understanding your own psychology is a day you are driving with your eyes closed. Open your eyes. The battle is not out there on the screen, in the news, in the charts, in the